we're back. I'm your host, BKP, and you know what time it is here Wednesday morning at 8:45 or 8:54, running a little late. It's time for Tax Tips, H&R Block with Beth Bennett. How are you today, Beth?
I'm good, Brian. How are you? A little riled up?
No, I'm calm. Well, no. How dare you say that about me?
I said we take it outside. I'm just kidding. Not that I'm a pot stirrer. That's how taxes I get.
I know you do. And listen, usually this is me, but I'm going to tell you, try to stay focused. Beth,
I'm sorry.
how are you today?
I'm good.
It's cold outside.
It is cold outside.
It is cold, but that doesn't change the fact.
It's snowing.
I know. That does not change the fact that it's tax season.
It is still tax season.
And they keep calling me from Blue Ridge. I'm on the automated thing to tell me there's a 2-hour delay for school, but it is tax season. What is our topic this morning?
Today I thought we'd talk about some unexpected taxable income, those surprises you get. You're not
Unexpected taxable income. I wanted to make sure I could say that.
You got it that time. Good job.
Yeah, I really don't deal with a lot of unexpected taxable income.
You'd be surprised.
Yeah.
Yeah.
Well, there you go. Unexpected taxable income. Every week we take a subject. Beth brings something in that she knows that people have questions about, and this is our subject for the day. What do you have there? What's your points?
So unemployment's always taxable. A lot of people don't realize that, and you should have taxes withheld. You can and should. Make sure you do that. You will get.
Now let me say, when you go to sign up, don't they ask you if you want tax or not tax?
They're supposed to.
Right. Well, what I'm saying is, so when you sign up for unemployment, if you choose do not take taxes out, that can hit you when you come to file. That's your unexpected. That's okay.
Yep.
Is that a big one? Does that catch people off guard? Or?
Well, it kind of depends what industry people are in. Like if you're in the carpet mills, they regularly get unemployment. Their teams go on rotating.
Right, I can see that.
Right,
happening.
so they go like every 10 weeks or 15 weeks or whatever. So they might draw unemployment 2 or 3 times every year. That's a normal for them. But if it's brand new to you, you've never drawn unemployment before, you're trying to make as much money in your pocket every week as you can because you've just lost your job. So you might opt to not have taxes withheld. However, if you go back to work and then you got good income coming, it could hit very hard at the end of the year, and so you don't want that to happen.
So unemployment is an unexpected. What else you have there?
We got lottery, gambling, raffle tickets, all that. Horse racing. If you win at horse racing, it's taxable income. Did you know that?
Yeah, I want you to write this down. Carla won $20 from me, and I want to make sure she reports that. I want to put her out.
I'll check on that.
Yeah, will you check on that? Because yesterday Carla got me for 20.
Tell the story.
No, I'm not telling the story.
You can't just leave it at that.
Made a little bet. She went to something. She went to the chamber lunch, and I gave her 3 words. It was a little silly game. I gave her 3 words that if the guest speaker said any of the 3 words, I won $20, and they didn't. So that was a silly thing.
Oh, that's pretty fun.
So Carla won $20. I just want to make sure, because that was an unexpected. See, I expected to win. So that was an unexpected game for Carla.
So you don't get to take that loss.
Yeah, tell her we do that. So gambling. Tell me a little bit about gambling. Is there a limit, like under a certain amount you don't have to report, over a certain amount, and how do you report?
Well, technically, you're supposed to report all income no matter what and how you earn it, period, no matter the dollar amount.
You have to report it, but over a limit, it's taxable, I guess. Or
it's taxable from day one.
I mean, from even the first dollar?
Well, yeah, technically, yeah.
Okay.
Yeah. So if you trade something, that's bartering. It should go on your tax return. Do people do that? Heck no. Right? They're not doing that. So if you gamble like at the casino or with the lottery, that's your most common you're going to see. We don't have horse racing anywhere near us. But you're not going to get anything until you've hit $600. So if you scratch a lottery ticket and you win $600, you're going to get a 1099-G from the lottery department. Or if you hang out at the casino a lot and you win big, you're going to get a 1099-G from them if you've hit over the 600. On the flip side of that, though, you can take your losses up to your winnings amount. So that's a plus, right? Because most people who gamble and get the $600, they've spent that to get there, right?
Right.
It's not that much that you just get, you know, you go and put $5 in this machine and win 600. So you can take those. You are required, you're not required to give it to your tax preparer, but you are required to be able to present your documentation to the IRS if you're ever audited. You know, your already scratched tickets that you lost on, any statements. You know, if you're at the casino, they'll give you a statement. Any tickets, you know, keep a log.
Right.
If you win a TV or a car, you have that's taxable. If you win it at work, like if you win, you know, highest sales for this week and you win a TV, that's supposed to go on your W-2 as taxable income at the fair market value price.
Okay, well, there's two that I do not have unexpected income. Let's try the next one.
Cancellation of debt, you probably don't have that either. So that's like if you lost your home for foreclosure or bankruptcy. In some instances, that could be taxable income. Generally on your home, if it's your main home, your mortgage was secured by your main home to buy it, to build it, or substantially improve one, then that's generally excludable. There's a special exception for that. But the most common that we see that becomes taxable is when people get a car repossessed. That becomes taxable income. A credit card is the most common. And people come in and they'll have $30,000 or $40,000 in credit card debt that they've negotiated out of or written off. And that's technically income, and you pay taxes on that.
You know, I read something, and not to get sidetracked, that is going to, I read that is not going to be highlighted on your FICO score like it used to be.
Really?
Mm-hmm. It's if you have settled debt, it won't be weighted as heavy on your FICO score any longer.
I think it should be.
Well, I'm just saying, I read that. You can check that out later. It's just an article. It has nothing to do with the tax return, but the FICO score. Now, on the cancellation debt, for example, is what companies say is, okay, if you owed, because we've seen this, and I'm not, it's not like I'm proud of it, but in the I call it the collapse of 2008.
Very common.
When our commercial building materials business, when we closed that, there was a lot of debts, and people said, okay, we're going to write the debt off, and you owed us $10,000. Then basically we're saying we gave you $10,000, and that's what you're talking about. So you
because
would get
technically you spent that $10,000,
right,
you received the product.
Right. So you would get a statement saying that that is unexpected taxable income that sometimes people don't realize.
Most people are mortified when they get that and bring it to us and realize what it is. They had no idea that it's taxable. They don't know what it's for. Sometimes we got to do research for them to get down to the bottom of where it came from, what the amount is. And there are some very special instances where you can get it excluded, but not often on the cars and the credit cards. The home is almost always excludable, but the credit cards and the car, not so much.
Well, you spent the money, and they say that we gave you that amount of money. So if you have a credit card and you wrote it off and it's $5,000, they say we gave you $5,000.
Yeah,
and that's
money because you went out to eat with it, right, or bought whatever with it.
So that catches people off guard when they come in and they have that?
Yeah, that's a pretty sad day.
What about our last subject? You have
the 401k. So a lot of people will take money out of their 401k to pay for whatever. Maybe they're buying a house, maybe they're buying a car or whatever. Unless you're 59 and a half, you're gonna pay the 10% penalty, right? Over 59 and a half, you don't have to pay the penalty unless you have exorbitant medical expenses that's gonna reach over the 10% on the Schedule A if you itemize, or if you become disabled in that year. The penalty gets waived, the 10% penalty gets waived, but not the taxes. And see, like if you call and you call your company's 401k plan and you say, I need to take out $20,000, they're generally just gonna withhold 10% penalty. So then when you come in to get your taxes done, if you add $20,000 to your regular income, that's taxable. Taxable income, because remember, when you put money in your 401k at work, it's deferred before taxes, right? So no tax has been paid on it. So that adds to your income. So it could put you in a higher tax bracket. That'll hurt you there. And it can phase you out. You reach some of the phase out limits and lose a lot of credits or highly reduced credits. So you want to be very careful of that. Like I said, most financial institutions, when you get money out of a 401k, only take out the 10% penalty. So then you're still left with your federal taxes and your state. Georgia's 6%, depends where you are for federal. And again, you could be in the 15% on your regular income, but then you take out 10, 15, 20,000. So now you might be in the 25%. All depends. So that's very scary. Lots of people come in and they'll Had somebody last year just took out $5,000, but that $5,000 that they took out of a 401k was enough to bump them, and they lost their child tax credit, got reduced crazy.
Just enough.
Just enough. Just
You know,
enough. So
you brought up a couple. You brought up a couple things. We're talking about unexpected taxable income this morning, unemployment, lottery and gambling, cancellation of debt, and 401k. And you see, there's several things. Now, you're open year round.
Yes, sir.
Okay, so there's several things that Beth Bennett here from H&R Block, our tax tips this morning, has brought up that, yes, it's tax season, but there are questions all throughout the year that a good tax preparer you should make friends with. She's easy to make friends with. There you go. That was simple. I introduced you to a bunch of people.
I appreciate that.
Beth Bennett, H&R, where are your locations? Before I do my eye test for this is my eye test for the week.
I know. You pass every week too.
We'll see today, okay?
All right, so we have 500 Highland Crossing up there by Walmart, 368 Craig Street, which you see behind us, and River Street. And remember, if you get any of these things are happening to you all throughout the year, come and see us or call your tax professional, let them help you plan. If if you win lottery, before you spend all that money, go see your tax professional, let them help you plan for that. If you have a cancellation of debt, if you need to take money out of your 401k, consult with someone before you do it. Doesn't have to be us, we're here all year, but talk to someone.
It is tax season, and yes, you can reach them at 706-635-5563. If you can't get there within their office hours, call them. They will do everything they can to accommodate their customers. And also, we want to stress again, this is year-round, and if any of these things take place throughout the year, it is best that you can contact your tax consultant, which I'd like to recommend Beth Bennett, H&R Block. We good?
We're good. Thank you, Brian.
Is it cold outside?
It is cold outside.
You want to take it outside?
Yeah. Come on.
We'll be back after these messages. We're going to continue our congressional 6th district congressional interviews. We're talking about that special election on the other side of these commercials. Take us out of here, Sam.